Hey everyone, and welcome to The Explainer. I am absolutely pumped you're here today because we are looking at one of the most chaotic, contradictory, and honestly fascinating financial periods in recent memory, mid-2026. I mean, we're talking massive institutional sell-offs, completely unexpected rallies, and a fundamental shift in how the world's biggest investors are viewing hard money. It's like a giant puzzle. So grab your notebook, get focused, and let's decode the 2026 market paradox.
Okay, let's just dive right into this, because the central mystery of the June 2026 market data is, well, it's a massive contradiction. We saw an absolute bloodbath in institutional crypto holdings, yet right at the start of July, Bitcoin's price suddenly snapped right back above $60,000. So how do you have record-breaking capital flight and a price bounce happening at the exact same time? To really wrap our heads around that, we first need to look at the sheer scale of the damage.
$4.5 billion. Let that sink in for a second. That is the record-breaking amount of net outflows from U.S. spot Bitcoin ETFs in June 2026 alone. Literally the worst month for redemptions since they launched. And this wasn't just, retail panic. This was heavily driven by the biggest institutional players in the room, particularly BlackRock's IBIT fund. When investors redeem those ETF shares, the issuers are mechanically forced to sell the underlying Bitcoin. It creates this massive, indiscriminate selling pressure on the asset, totally regardless of broader market sentiment. But what made early 2026 so historically unusual is that it wasn't just Bitcoin taking a hit. Amidst this really grueling macroeconomic landscape of higher-for-longer interest rates and intense geopolitical tension, investors were reducing their exposure to pretty much everything. Bitcoin plunged 31% from its late 2025 highs, falling back to that 60,000 range. Meanwhile, gold, the ultimate traditional safe haven, also dropped 6%. Seeing both traditional and alternative stores of value crashing simultaneously, that is historically incredibly rare. Both assets, which usually move inversely to market stress, were down. It was like all the safety nets seemed to be failing at once.
All right, moving to Section 1. Enter Fed Chair Kevin Warsh.
Markets rarely move in a straight line, and every heavy sell-off eventually finds a catalyst. On July 2nd, Federal Reserve Chair Kevin Warsh was speaking at a conference panel. He stated inflation risks have come down and signaled a lively policy debate coming at the July Fed meeting. Now, in the financial world, those 5 words are pure electricity. For a non-yielding asset like Bitcoin, high interest rates are basically the biggest headwind. So any hint that rate cuts might be closer than expected acts like absolute rocket fuel. After 11 grueling months of selling, futures traders had built up massive short positions. Warsh's comment triggered a huge short covering rally, meaning traders were rapidly buying back positions to close their losses, which mechanically forced Bitcoin's price right that above $60,000.
But here's the really crucial point. You have to separate a short-term mechanical price squeeze from the long-term structural reality. While the price definitely bounced on July 2nd, the institutions were quietly taking a step back. On that exact same day, Citigroup completely slashed its 12-month targets. They dropped their Bitcoin target from $112,000 down to $82,000 and cut Ethereum from $3,175 down to $2,240. Why? Because the structural demand picture was just cloudy. They cited the collapse in ETF demand and continued delays to the U.S. Clarity Act, which was a piece of crypto regulation that institutions desperately wanted to see passed to give them some real confidence.
Which brings us to Section 2, the Great Decoupling. And this brilliantly illustrates what was happening right beneath the daily price swings and the ETF outflows. A massive macroeconomic shift was taking place. For years, investors basically treated gold and Bitcoin like twins, both supposedly hedging against the dollar and inflation. But 2026 totally shattered that mirror trade. They are now taking on 2 very distinct roles. Gold has firmly established itself as the geopolitical bunker, the ultimate shock absorber. Bitcoin, meanwhile, has matured into a global liquidity sponge, a high-performance tech proxy that really thrives when global money supply and risk appetite expand.
So right now, capital is desperately seeking the bunker. But why exactly is gold winning this institutional trust war? Well, first off, central banks are buying it at a staggering pace. We're talking accumulating over 4,000 tons between 2022 and 2025 alone. Following the 2022 seizure of Russian assets, sovereign nations realize they want a non-sovereign reserve that simply cannot be sanctioned or switched off by a foreign power. Plus, there's a new technical shadow looming over crypto, the quantum threat. Major firms like Coinbase and BlackRock have warned that roughly 32.7% of all Bitcoin is theoretically vulnerable to long-range attacks from emerging quantum computers. Gold? Gold doesn't have software vulnerabilities. It is an unhackable, purely physical refuge.
Now, what's really interesting about this data is the sheer imbalance it reveals in global portfolios. According to the In Gold We Trust report, gold currently makes up just 2.7% of global liquid wealth. Compare that to the staggering $140 trillion global bond market. Just think about the math here for a second. If institutions decide that government bonds are no longer the ultimate risk-free asset because of, say, structural inflation and mounting debt, and they decide to reallocate just 2% from global bonds into gold, that would equal nearly $3 trillion. That is an absolute tidal wave of capital entering what is a relatively small market.
Let's look ahead in Section 3, the future of hard money. So, where does this actually leave us as we look into the next decade? What is the future of hard money in a multipolar world where trust is so incredibly scarce? Well, the valuation gap between these two assets is still massive. Bitcoin remains a fraction of gold's overall market capitalization. But here is the fascinating twist. Analysts actually note that gold's success might be the greatest long-term catalyst for Bitcoin. As gold regains its monetary significance on the world stage, it naturally brings institutional attention directly to the concept of scarce, non-inflationary assets. Once an institution buys into the bunker, they almost inevitably start looking at the sponge. Gold provides that much-needed monetary stability, while Bitcoin provides the technological convexity and mobility. They really aren't just competitors anymore. They are morphing into this highly symbiotic portfolio strategy. And because of all this, the targets for gold are adjusting rapidly to this new reality. Back in 2020, the Incrementum report set what they thought was a conservative 10-year target of $4,800 an ounce. Well, that target was essentially blown past 4 years early in 2026 as gold surged. Because that timeline accelerated so dramatically, market focus is now shifting to their extended inflationary scenario, which actually projects gold reaching $8,900 by 2032. We are quite literally moving from a world of financial abstraction back to physical reality, where holding hard assets fundamentally outpaces paper promises. Which leaves us with this final, genuinely critical thought to ponder. We know capital doesn't just vanish, it rotates. Right now, in 2026, the institutional capital is firmly parked in the gold bunker. But what happens when that bunker gets too crowded, the trade becomes entirely saturated, and all that immense liquidity decides to rotate right back into the high-performance sponge of Bitcoin? If you are planning your financial future, understanding this great decoupling isn't just interesting, it is absolutely essential. Think about how this multipolar financial reality impacts your own allocations, because the rules of the game have definitely changed.